right, I think we are live. Hello, everyone, and welcome to this week's edition of the Dividend Power Hour. If this is your first time joining, my name is Mark Rushin. I'm a CPA here in the state of California. It's great to be with you today. If you're able to join us live, if you're watching the recording, thank you for that. Make sure you do hit that like button down there. Show your appreciation to both myself as well as Google. And if it is your first time joining, we like to make this interactive. We like to talk about what is going on in the stock market, which has been a lot. So we do have a lot to talk about as we enter into earnings season, which has been a little bit of a mixed bag. So we'll talk more about that here today. But if you are just joining, whether you are a returner or first time, let us know where you're tuning in from. Where are you tuning in from, and what are some stocks you may have sold or bought in the last week? So we met last week on a Tuesday. So now we're back to our regular scheduled time every Wednesday afternoon at 4 p.m. Pacific time and 7 p.m. Eastern time. So lots of static. Can you guys hear me all right now? Are we back? Looks like we're back. How about now? Audio, any audio? Showing audio on my end. Any audio on your guys' end now? Okay, we are getting some yes. Awesome. Thank you guys for letting me know. I did hit the cord here. Didn't know it would take the whole audio out. So we are back now. So let me know where you guys are tuning in from and where you guys or what you have been buying or selling, because there's been a lot of selling going on. So, all right, let's jump into the comment section here to see what is going on. Who's tuning in? We got Georgia tuning in from Jamaica. Georgia, great to have you. Cameron, we were not on mute. I hit that cord there. So hopefully we're back and you can hear me again. Sounds like everyone else can hear me now as well. What else we got? Carl tuning in from Tennessee. Carl's been buying some VIG, some Celsius. Celsius has been down a lot. I've been selling covered calls on that position for quite some time now, making some good money, but would like to see it return to some growth again. So we'll see. What else we got? I can hear you. Good audio. That's better. Perfect. All right. Drew's tuning in from Minneapolis, Minnesota. Matthew, good to see you, my friend. Green Bay is in the house, getting ready for football season there. What else we got? British Columbia is in the house. What do we got? Orange County. Look at this. NVIDIA and Amazon. Bobby must be a neighbor. Sweden is in the house. Danny, great to have you. Frank from Arizona. It's got to be pretty hot there in Arizona. It is here at Southern California, and likely Bobby knows as well, it is in the low to mid 90s here, and we are not too far away from the beach. So we got Frank from Arizona, Savannah tuning in from, or Gomer's tuning in from Savannah, Georgia, Chris from Baltimore, Tom from Florida, Jeffrey, good to see you. Don't hit that mic cord, may bring down the stock market. Too late. Yep, exactly. Who would have thought that just barely touching this mic cord, everything would just go out on it. So that's technology for us though, right? Drew's been buying REITs like a mug. All right, Seminole, Florida for Linda. Good to see you, Linda. Skippy's from Buffalo, New York. Picked up some Visa, Google, Amazon, all stocks that were down today. So those are some good ones to buy today. Taylor's, South Carolina. Ireland's been buying some PFE, some Pfizer, which I like. Like to hear that. Someone's been watching the latest videos. Daniel Perez from Florida. What else we got? Ryan's been DCAing into some Google. What else we got? Bay Area's in the house. 109 degrees and no wind out in Arizona for Frank. Wow, that is some serious heat right there. Just bought some SCHD for Mario. Vermont in the house. Haven't listened live in a while, but always listen to the recorded version on my commute. Bought some SCHD. Jeremy, good to have you live. It's always great to be live. We're always looking for this to be interactive, and we all have one common goal, and that's to build long-term sustainable wealth here. So Ricky's dipping in on some crowd and some REITs. Hey, Mark, will REITs like American Tower and Vici dip if we enter a recession? Well, it's really going to be dependent on the type of real estate that the REITs that you're looking at have. So these ones being casinos, and you want to look at the operators that they lease to. Can these operators still pay their rents? That's really what the REITs are about. So Vici, yes, they own Caesars Palace and MGM Grand in New York, and Mandalay Bay. But whether the how should I put this? Whether the casino's doing well or not isn't their first priority. Obviously, they want the casinos to do well, because if the casinos are doing well, the operators are doing well. And if the operators are doing well, they're able to pay their rent. But they want them to do just well enough to be able to pay their rent. And if you look at Vici went through that period of the pandemic when REITs were just collecting roughly 50% or even less in many instances. The rent that they were supposed to collect, many REITs were only collecting 50%. When it came to Vici, they were one of only less than a handful of REITs that had a 100% rental collection, cash collection from that standpoint. And they have actually never dipped below 100%. What they have expected to collect each and every month is exactly what they have collected each and every month from that standpoint. So hopefully that helps make sense from that standpoint. TC, good evening to you as well. IBM, PepsiCo, J&J, Sean from Singapore, Florida for Daniel. Amazon, Google, Meta, Snowflake, and Path. Wow, some big time technology type stocks there. Payday today, so hoping for more of a dip. Don't you like when it works out that way? First time live, tuning in from Appleton, Wisconsin. Bought some some Avago, which is Broadcom, and some Microsoft. Then the market dipped. Well, hopefully it's long term, and that's why we don't like to back up the truck. So hopefully you're just dollar cost averaging into it, and you'll get more opportunities, I believe, moving forward to able to buy some more of your favorite names. Usually listening at work, very thankful you do it earlier before I get busy. Bought some Crowd on the huge dip at $2.99. What do you think? Crowdstrike's got some reputational damage. They have some major issues. They have many companies out there, considering how much it impacted the entire world, the global economy for that matter, that you probably have a lot of companies saying we need to diversify. Just like I talk about diversification when it comes to investing, they need to diversify a lot of their cybersecurity infrastructure for that matter, and not rely so heavily just on one particular company. My wife works for a large insurance company. Her entire computer was just completely out. Now I'm on an Apple device here, so I didn't have any hiccups from my end of the spectrum when all of that was going on. But I know, and we all saw how many companies were impacted. So I think there's a lot of reputational harm. I think there's going to be a lot of lawsuits that come out. This is one where I'm going to take a wait and see approach. I loved Crowdstrike. I got out of it prior to all of this, about a month back or so. So to see the dip is you're thankful that I am thankful that I did get out, but it was a company that I was hoping to get back in. Now, was I hoping to get back in because they were still performing at a great level and maybe the stock just sold off because of people taking some profits? Yes, that's the ideal situation. But because of having issues with rolling out, I don't know if they, had the intern rolling out the updates or what it may be, but that it was a major screw up on their part, and they have a lot of trust to build back up. So in that case, probably one that, I could see people saying, hey, I want to take a flyer on it and understand the risks that come with it. But for me personally, in my portfolio, Crowdstrike's not in there right now. King David said, some people think we are already in a recession, but I don't want to be official because of the election. It could be, it depends on, the economic data there. So kind of what people look for is they look to GDP. And once we have 2 consecutive quarters of negative GDP growth, or lack thereof, I should say, that's kind of the official, is when people want to call it a recession. Right now we're hovering around, 1%. So, it could be there. There could be some, manipulation in the data. And then you always want to look at the adjusted figures, not the first figures that come out for everything, whether that's GDP, whether that's jobs numbers, employment, so on and so forth. So always be mindful of that. All right. So what else we got here? Some Pfizer, some Visa, BTG. Vince has got a question at $500K to invest, needs some help building a diversified portfolio. Where would you start? Well, Vince, when it comes to that, these are some of the things that we talk through in our one-on-one program. So our coaching program, the Investing Accelerator. We just started our group coaching program. But if you're looking for more of that customizable approach where we get to talk about portfolios and looking into my portfolio, diving into valuation, analyzing stocks, then you definitely want to check out our one-on-one coaching program. From that standpoint, I can drop a link down in the description as well if that is helpful for you. Or you can shoot me an email, mark@russinfinancial.com, and be happy to give you all the information from there as well. Do I have any alternatives to Crowdstrike? That's a good question. So It's not a one for one in terms of same exact offerings. They are slightly different. They are both in the cybersecurity space, but in terms of their offerings, they can be slightly different. And a stock that's been on my watch list for some time has been Palo Alto. Now, when you look at Palo Alto and you look at what the stock has done since this CrowdStrike debacle, it hasn't moved, as much as I thought it would have moved. And it could be some of the lack of similarities between the two. But, even prior to this debacle, though, it's a stock that I've been waiting and patiently to get into. But that could be an alternative there. What are some of the other ones? Zscaler is out there trading at a premium in terms of multiple already, though. So tough from that standpoint. SJ tuning in from Honolulu. Sunny man, good to see you. Hello. Added to my utility stocks this week. Tempted to buy ups or UPS, buy ups. By UPS. So I do like the utilities right now, especially if we're going to enter into this period where we see a big rotation. And now it was pretty much a rotation out of everything today. And there was a lot of high quality stocks that were still down. Is utilities and energy could be two spots to look at as managing your own portfolio because of the cycle that we could be entering here. And as you manage your own portfolio, again, that's something we talk about in our one-on-one program. Which sectors do you want to be more heavily exposed? Now, when I talk about diversification, that doesn't mean well diversified exactly to each and all 11 different sectors. You got to have X percentage here and X percentage there, equal across the board. That is diversification to the T, but at the same time, that's missing out on opportunities. If you are active and actively managing your own portfolio, you want to be diversified, but also have overexposure and low exposure to certain sectors in certain cycles. And when the cycles change, you want to switch those and be, constantly moving it from that standpoint there. And you could still take a wait and see, a long-term approach while doing this as well. So just be mindful of that. All right. A lot of great questions there so far. Let's jump into our slides for the week. So here we go. And again, welcome to the Dividend Power Hour. If you guys are just joining us, my name is Mark Rusin. I'm a CPA here in the state of California. And if you are returning, you're probably familiar with our update slide here. So here's a look at our economic update where we take a look at the markets and some key topics we'll be discussing in today's Dividend Power Hour. So markets, Dow Jones up 5.7%. Last time we met, we were up 9.3, almost cut in half from that standpoint there. S&P 500 up slightly below 14%. Last week, they were up 17.2%. So a nice drawback there. The NASDAQ up 15.5% on the year. Last week, we were up roughly 20%. So a 5% pullback or so in the last week. And then the small caps were up big. That we went up from pretty much being flat 2 weeks ago to up over 10% to now coming back down as they sold off a little bit today, 8.5%. However, when you look at the small caps, they have been outperforming of late. They've been outperforming on the up days, and even today, they were outperforming technology yet again, the S&P 500 on the down days. So still losing, but performing better than some of those mega cap stocks and a lot of those companies that have been working for the past year. So still an area of interest, an area to focus on there. In terms of valuation, we are finally ticking back under 20 times multiple. And again, this is a forward-looking multiple now. So now we've actually transitioned to 2025. So we're looking at the EPS of 279, which is about the street average right now. Historically, as you can see, the 10-year average is around 17.5 times right now. We're slightly below 19.5. So it's starting to look a little bit more reasonable, but we are still a little bit elevated there. So, if we were to get closer and right around, 18 times multiple, then that's going to look like something. And if we can kind of get to that 279 in terms of EPS on the S&P 500, that's going to be right around S&P 500 5,000. So that can kind of tell you how much we could potentially fall in the markets if we in fact get to S&P 500 from that standpoint. So right now, if we're looking at where the S&P 500 is right now, we're at 54.46. So we could potentially lose another 200 points, which is roughly about a 6-7% drawback there. That would give us our first correction in the market as well. Usually, typically, on a given year, you get at least one market correction. What is a market correction? A 10% pullback from the recent highs. We haven't got that. We saw something in April, which was about 5.5%, but then we bounced off it. We're going through something right now where we are down roughly the same as what we saw in April. The triple Qs are down a little bit more than that, so they're approaching that correction territory. So we're waiting for it. We've been looking for it. Now we might be getting that correction where we're just seeing a lot of folks taking profits, but we also happen to be in that very update area when it comes to earnings. So when stocks are priced to perfection, they're priced extremely high, valuations are well above their historical averages. If companies don't not only hit but easily beat earnings, well, you can see stocks pull back. Alphabet had a fantastic quarter. However, they talked about CapEx spending increasing from that standpoint. That's the exact playbook we've seen from the likes of Meta. Meta did this, what was a quarter ago, 2 quarters ago, and the stock fell off something like 15, 17%. They beat on earnings, beat on revenue. However, their forward guidance brought down revenue guidance and increased their capital expenditures. Again, when it comes to investing, folks, and I tell my students this all the time, it's less about what you did for me and more about what you're going to do for me. Investing in the stock market is forward looking, constantly looking forward to what's going to happen. It's great that that's what happened. It's great that that's what you did for me. That's what you generated. But I'm investing for you to not only continue to do that, but to increase that. We want to see further growth, and we want to know how are you going to do that. So when you tell me that revenues are coming down and spending's going up, that's two things going in the wrong direction. Now, it's hard to, as an investor right now, to take those numbers and say, okay, I understand we're investing now, but what is that going to turn into? Is that going to 4x our revenues? Is that going to 4x our EBITDA and our margins and things like that? That's what you as an investor have to try and figure out. Do you believe in the management? Looking back at investments in the management, have they equated to higher revenue growth, higher margins, better efficiencies, so on and so forth? That's what it takes to when investing and managing your own portfolio from that standpoint. So when we take a look at interest rates, we see the 10 years at 4.25, and we see the 2-year was relatively flat from last week, sitting at 4.4 right now. So still, coming down, albeit slowly from 2 weeks ago, but we had a slight uptick, especially on the 10-year here. In terms of the markets, tech sell-off. That is what today was all about. A very large sell-off. It was one of the largest we have seen in a number of months there. Now the question is going to be turning to tomorrow. It's going to be turning to tomorrow, and it's going to be turning to the rest of the week. Is this a sell-off that has legs? Is this a sell-off that is not just a quick bounce up? Is this something that's going to continue to where we start to see these big hedge funds, because that's the big money managers that are starting to sell and take a lot of the profits that they've earned over the past 12 months or here in 2024? That is the follow-through. The follow-through is going to be one of the most important things here for these next few days to pay attention to. So Google reported earnings today. Yesterday, and Tesla. Both of those companies, two very different reports. Google, I thought was, or Alphabet, I thought was pretty good. They did increase their overall capital expenditures, but we just talked about that. That's the same playbook that Meta took, and stocks bounced back from that. Tesla, on the other hand, is kind of falling right now. Margin pressures all over the place. Earnings nowhere near. So that is a company that is continuing, and we've talked a lot about it. You guys know my love for Elon Musk, not no love at all, really. Is the guy has a brilliant mind. Elon Musk has a brilliant mind. And I get people tell me all the time, hey, have anyone ever told you look like Elon Musk? And I said, yes, I get it all the time, but my bank account doesn't. So I would rather have my bank account look like Elon Musk and not actually look like Elon Musk from that standpoint. But I don't know really is that a compliment or not. I've seen some of his pictures, but the other day someone said, for those football fans out there, that look like Matthew Stafford. That one's probably a better one. I'll take Matthew Stafford from that standpoint there. But when it comes back to Elon Musk, brilliant mind. The innovation and things that are going through it, how he's able to come up and land a space rocket on a floating ship. Brilliant mind how they do that, and the autonomy with the EV cars and bringing all of that and the batteries and all of this stuff. Brilliant mind. But from a leadership perspective, with the way that he manages investors and all the Tesla fanboys that are out there, lacking. Probably in the lower echelon of all S&P 500 leaders that are out there. When it comes, I've been around business for many years. I was a VP of accounting for a very large real estate company. And when it comes to all of the different steps that I've took to get there, it's always about over-delivering. It's under-promising and over-deliver. You don't want to get everyone all hyped up and then you always fall short. That's exactly the route that Elon takes. Elon is constantly over-promising and under-delivering. full autonomy has been so late from that standpoint there. It's still not even here. Now we're talking about, the next phase that is supposed to come out. And we're talking about robo-taxis. Those probably won't be around for another 2-3 years at a max. He's talking about, oh, it could be around, next month. Then it's pushed to October, and it's going to get pushed out to next year. It's just a constant phase, but everyone gets excited. And then he has the verge to go out and say, hey, if you don't believe in it, then sell your shares. Sure, that's for the investor to figure out, but why would I ever want to invest in a company that has a CEO that's telling investors to sell their shares? When we have more investors that sell their shares, stocks go down. I don't want to lose value. I understand that there's opportunities that come about here and there that we can go buy stocks on the cheap, high quality stocks on the cheap. I don't want the C-suite folks telling others to go and sell their stocks. So from a leadership perspective, not a huge fan overall there. So I look more like Musk. I get it all the time. It's the hair and the head shape. Not a bad thing. Okay, thank you. Oh, there we go. I look exactly like Mark Rusin. There we go. Don't sell, keep buying. Cindy, no worries. The sell-off has some legs. I am not going to disagree with you there, Rob. What's up, Mark? Was a brutal day. It is a brutal day, but at the same time, for us long-term investors, which I would say the majority of us that come on this show on a regular basis are long-term investors. And these are the opportunities that we want. We would rather have the opportunity to buy high-quality companies at much cheaper prices rather than chasing companies from that standpoint. And it's gotten to a point, really, where we've had this run-up in stocks, and we now have to get to the point where we need earnings to back it up. So when you have these heavy, extremely high premium valuations that we're going through, we need to be able to have earnings back it up. And if they don't, in fact, back it up, that's when issues persist from that standpoint. So let's go over to the iPad and let me see if I can kind of show you what we're talking about here, what we've been going through overall in terms of where these companies are been, what is the premium things that we need to be mindful of here. So I'm going to show you here's our iPad here. So let's say we have stock A. So hopefully you guys can all see that there. There's stock A. Stock A, we'll say at the beginning of the year, traded at $100 from that standpoint. So this is our stock price, and this is going to be down here, our earnings per share. So at that point in time, we'll say they had earnings per share of $5. So right now, that particular stock trades at a PE of, what do we got? 20 times. Drew a blank on my math there. So not bad for a CPA. So let's say that this is a stock that continues to climb. Let's say, and we'll say the EPS was $5 in 2023, whenever you want to call it here. But we've gone through this euphoric period where it seems like the stock market only increases from this standpoint. So you have stocks that are up, 40% through the first 6 months, 60% through the first 6 months here. But that is driving up the premium on the stock. Let's say that, the 5-year average for a company is right around, we'll say it's 21 times. So at this point in time, the stock was pretty much fairly valued. It was a slight discount. We were able to buy the stock at 20 times. Historically, investors pay 21. So a slight discount there. But now at this point in time, we have stocks that are up 50%. So now we look ahead, and this stock is not $100 per share. It is now $150 per share, which we'll just say up 50%. Okay? So up 50% at that point there. And now earnings per share, when we look at earnings per share, we'll say, well, that increased plus 10%. So it's still growing at a double-digit rate, but we're only at 550. And you could see how the premium starts to get away. We have the stock price that continues to grow at a rapid pace, but at the same time, you don't have the earnings that are following at the same pace. And that's going to make a stock get even more expensive from that standpoint. So if we take now 150 divided by 550, now we have a stock that was trading at 20 times, which is now trading at 27 times. We need to allow that stock price to come up or to come down, or the earnings per share to start catching up. We need to wait, and that stock price needs to hover around 150, and we need to get things back to maybe, let's call it a $7 EPS, because at $7, Now we're back to 21 times. And you could see how the valuation changes from that standpoint there. So that's things that people are going through right now, saying, hey, this stock has reached too high from a fundamental perspective, extremely rich on these stocks, especially the technology sector. And at the combination, folks are going over and looking at the actual technical perspective too. So hopefully that was helpful from that standpoint. But that's exactly what we're going through in the markets right now. Is folks are saying, hey, if this stock doesn't hit perfectly on earnings and we're not growing at a rapid pace, because as EPS goes up, or as the stock price goes up, we expect earnings to go up. We are paying a multiple that is expecting strong growth. And even though we're getting double digit 10, 15% growth, well, the stock price is up 50%. I better have some growth that's going to show that moving forward, because it goes back to what I said earlier. Investing is less about what you did for me and more about what you're going to do for me there. So hopefully that was helpful from that standpoint there. All right, let's jump back into the slides. So we had Google reporting earnings yesterday. We had Tesla reporting earnings. And since we have had that June CPI report, we have seen the triple Qs, which is largely led by technology, fall down 7% off its recent highs. So again, remember, a correction is going to be 10%. So we're nearing a correction in the triple Qs. Right now, we're only at around 5% or so in the S&P 500, but we'll take a closer look at those here in a second. So buy the dip, though. Is it time to buy the dip? We have seen the stocks fall. We have seen many large companies fall, but is it time? It's only been one day, folks. So this is something that I personally believe, doesn't mean it'll happen, that this could potentially have legs from here. We need to get to that one correction. It's healthy. Stocks can't just go up from that standpoint there. So it is healthy. It's part of the process. So just keep that in mind. And it doesn't mean you need to panic. I don't believe that this is an area of panic. I believe it's an area that, hey, it's important to have cash available. That's why I always like to have roughly, 3 to 5% of your portfolio in cash at a minimum, because you never know when opportunities are going to persist. When are opportunities going to come about in stocks that you've been following? And that's why I've talked a lot about, and I do so in my coaching course as well, is it's very important to do your due diligence ahead of time, because you never know when those opportunities are going to come. But when they do show up, you've already done your due diligence. You know the area that you would like to buy a particular stock. Now that it falls there, boom, you're ready to go. Rather than seeing a stock come down 5, 10% in a matter of a week or so, and then you're scrambling to see, well, is this, it's down 10%, I should probably just buy it, not knowing whether did something happen? Did it come down just because the market sold off? Did it come down because they said they were spending more? Did it come down because there was delays in a product that they were pushing out, that they were planning on growth? What was the reasoning there? And that's why it's important to do the due diligence ahead of time from that standpoint there. So we'll be looking more at that. And then we'll be touching a little bit on housing. So we've seen rates retreat off their highs when they were up near 8%. So they're still hovering around 7%. So that is helpful, albeit high from what we've been accustomed to the past few years. Existing home sales in the latest report disappointed. New home sales really disappointed, and they've hit a 7-month low from that standpoint too. So we'll be taking a quick look at that as well. So let me jump over into the comment section just to make sure I'm not missing anything important there. All right, Mark, if you could only invest in REITs or SCHD for the rest of your life, which way would you go? Wow. It's like picking my favorite child. Invest in REITs. So would I have to pick an individual REIT and SCHD? If that's the case, I'd probably go SCHD, just because that's going to give me access to, 100 plus stocks from that standpoint there. So it would be SCHD, because I don't want to be focused on just one particular sector. As much as I love real estate, as much as many self-made billionaires and millionaires have been attached to real estate and built a lot of their wealth through real estate, whether it's, buying private on their own or investing through REITs, it's just a different way to get that real estate exposure. Probably going to have to go through SCHD, because SCHD is going to give me exposure to energy, to healthcare, to financials, a little bit in technology, so on and so forth from that standpoint there. So it definitely would be SCHD there. All right, what else we got? Be careful in REITs. I agree, Neil. I wanted to buy more NEE, but it ramped up so fast. NEE is more on the utility side, energy side of things, not a REIT, unless that's a answer to a different question. I don't know. What else we got? Am I missing anything else? Great lesson on the iPad just now. The lesson on the stock splits last time was also good. Good. I'm glad you guys like the iPad. I never know whether to bring it out or not, and if you guys like it, but leaving comments there definitely shows me that you do. So we'll definitely do more on that moving forward. Here's a question. Do you use inverse funds to hedge? What would be an example of an inverse fund that you'd be referring to there, Jeff? I'd like to see one of the examples just so I'm make sure I'm answering this correctly. Steven said SCHD for the dividend growth, the diversification, and for tax purposes. That's in relation to the question earlier, I believe. Cameron said, do you recommend investing in individual tech stocks as well as VU, or just go the ETF route? And I think it's really going to come down to your personal strategy. How hands-on do you want to be? How risk-averse or risk-tolerant do you want to be? More risk-averse, hands-off investors want to stick to the ETF route. But for me, I like to build a foundation first and foremost, and then sprinkle in individual stocks. I like to take a little bit more risk from that standpoint while also being risk-averse at the same point. But I think the question alludes to is, can we mix and match? Because at the top of VOO is going to be Apple, Microsoft, NVIDIA, Amazon, Alphabet, so on and so forth. Can you also mix in Apple, Alphabet, Microsoft, NVIDIA, so on and so forth in individual holdings? So just for reference, I own an S&P 500 index fund at the top. That'll always be my top position as long as I'm investing in the markets. One of my largest individual positions, which is my fourth overall, is Alphabet. And in the top is also Microsoft and Amazon. But I think it's understanding how much exposure do you have. You know, if you have 15% exposure to the S&P 500, well, you know that X amount of that is Alphabet and Google. So just start including that. So for me, individual stocks wise, I usually don't want to see an individual stock get higher than 10% of my overall portfolio. And that's why I like to bring all of my portfolios together for that reason, to understand, making sure that I'm not overexposed to any particular sector or any particular individual stock from that standpoint there. Okay, SQQ was the example that I had in my head there. And Jeff, no, I personally do not from that standpoint. So I did do a triple hedged QQQ trade the other day. It was very short term. So I made about 5% on it. Nothing crazy from that standpoint. Luckily, I got out of it. I had a stop loss on it. So we got our 5% gain. That was just this week, actually. But very rarely do I use any of those. Maybe less than a handful of times per year, if I'm speaking honestly from that standpoint. So hopefully that helps answer your question. But, you know, funnily enough, I did just, in fact, use that. Are you buying Tesla tomorrow? Absolutely not. I utilize Tesla for option play. So, you know, big time option premiums with Tesla. But, you know, holding a stock like that with a CEO that's going to be all over the place. You never know what he's going to talk about over the weekend. You never know where his focus is. You know, someone that, how can they run one of the largest companies in the world and also run 9 other different companies or whatever it may be? So I want to invest in a company that has focus at the top of the ticket there. Cartridge. I buy REITs mostly. I'm looking at MPLX. Also, any thoughts on this stock? Not one that I own. So when it comes to REITs, it's usually around a handful or two in terms of individual REITs. So I've been covering the REIT sector for over a decade now. One that I'm well versed in. I just want to focus solely on quality. I'm not looking for any speculative type plays or hot shots that have some momentum type things. It's nope. I'm just sticking to the best of breed when it comes to REITs. So maybe I own 6 different REITs right now in my portfolio. But I want to keep that around 15% or so of my entire portfolio when talking about REITs in general. So I like to build my own mini ETF when it comes to REITs. What is a good energy ETF? Good question. So for me, again, energy is not one that I follow as closely as I do many other sectors in terms of individual stocks. So for that matter, when that's the case, I usually just invest in an ETF. So energy and utilities are two that I don't follow. Although I follow them, especially the large ones, I don't follow them all that closely. So I have some ConocoPhillips individual stocks, but I also have XLE. So XLE at the top of that is going to be mostly ExxonMobil and Chevron, and then little ConocoPhillips. But if you want to exclude those two big giants and look more closely, like if you were like, oh, I want some oil and gas type of exposure here, that would be IEO. That's another ETF that I've owned in the past there that excludes those two giants from that particular ETF. So if that's what you're looking for, take a closer look at those two in general. That was exactly my question. Thanks for the answer. You are very welcome there. I do not follow AT&T. So I've held AT&T years ago, back when everyone was talking about, buy AT&T under $30, and then it cratered. I'm glad I got rid of it. But I did see it had a good quarter here. Didn't look at what had happened. I'm assuming their subscription, their ads beat expectations, but don't quote me on that because I do not follow the stock as closely as I once did. So, Praveen, good to see you, my friend. Looks like today the market was down. Is there any company that we can buy which can be treated as a discount in your opinion? So again, as I was mentioning earlier here, Praveen, is the fact that I think this is something that has legs. So I think it's important to have a list of individual stocks or ETFs that you're looking to get into, and find where they're trading at now at today's valuation. And Praveen's taken the 6-week course with us. He's in our group program right now. And we've talked about in what the valuation piece is. We know where valuation is now, but where has it been over the past 5 years? Where has it been historically over the past decade? Has anything changed in the company now that deserves a different premium? Is it growing faster to where maybe, and it's more efficient to where maybe the valuation should be higher? Or should it be lower? Is it starting to mature more and the growth is slowing to where maybe it doesn't deserve the multiple that it once did? Those are the things you have to ask yourself as an investor from that standpoint there. So good question, though, overall. So awesome. Well, thank you guys for the questions so far. Let's keep jumping in here to the slide deck here so that we can keep things moving here. So let's take a look at the fear and greed index. So if you recall last week, if you were with us, we were sitting pretty much right dead smack in the middle. We were right around 50 in the neutral. But with that sell-off, we have seen the fear and greed index fall slightly into that fear level. So there's a level of fear that's starting to creep into the market. This is telling me that potentially we could see some more volatility, and potentially this pullback does have some legs. Again, recall what I said earlier. We usually get at least one correction per year. We have not gotten that in a very long time, and we have not even gotten close to one here in 2024. I think about 5.5% was the lowest that we went overall from that standpoint there. So, alrighty, so let's do an audience question. So for the rest of 2024, which of these 3 ETFs would you rather buy? Is it QQQ, VGT, or SCHD? Let me know in the comment section. Is it QQQ, a mix of technology heavy but other sectors, VGT, which is going to be just strictly technology, or are we going to go a little bit more broad, less technology focused, more dividend growth focused with SCHD? So for the rest of 2024, seeing that we are coming across some technology hiccups, we can call it right now, not a full-blown correction yet, but I just want to see what is the audience feeling so far. So we got SCHD, another SCHD, another one, QQQ, SCHD. Edgar's going just on his own. SCHD by far for Austin. James, SCHD. Awesome. Love it. Okay. I think SCHD, QQQ is discounted though. One short 2%, 5%, 7%, whatever it is right now, pullback wouldn't look at what it's done. Not much of a discount right now. That's for sure. Jeffrey going SCHD. There's a VGT. There we go. We got some VGTs coming in now. SCHD. I own SCHD and VGT for JC. Good to see you. Frank's going SCHD. Mike going SCHD. Paul's going SCHD. Leo's going SCHD. Okay, so I think it's pretty clear here who won this particular poll here, and it's definitely going to be SCHD. So everyone's looking more for that broad exposure there. So if you recall in last week's, if you join us, we looked at technology stocks because we were starting to get a little bit of a pullback, not as much as we saw today, but just last week, those are the same exact stocks with the same exact rates that they've been down off their 52-week highs. I wanted to take this slide and update it to show you where are they at now just a week later. And they're all lined up pretty much exactly the same. And there happens to only be one particular stock that is lower, that actually did better, I should say, than it did in the prior week. And that is Meta. So AMD went from down 30% to today now being down roughly 35%. Qualcomm's down another 4%. Nvidia's down another percent. Broadcom another percent. SMH down another 4%. But Meta is the only one that was down 15 and now is only down 14. So they're the only one out of all of these that we looked at last week that is actually positive since then. Amazon is down roughly 4% from last week. And even Microsoft down another 3+% from where we were at last week. So very interesting to look at those and where that is at from that standpoint. So now the two big ones. These are the two big companies that reported earnings yesterday, which was Google and Tesla. And we've already touched on them a little bit here, but Google, in terms of their stock price at $173, we'll call it, and we're rounding overall. At their 52-week high, we can see that they are down 11%. So Google itself is in its own correction mode. Tesla, on the other hand, is in a full-fledged bear market at this point, down 22% from its 52-week highs there. So let's dip over to the iPad here, and let's take a closer look at some of those earnings that we saw for Google. So here we go. Here's Alphabet, and I keep calling it Google here. We could see that Alphabet reported, get this going here for you guys real quick, GAAP EPS of $1.89. That beat by 4 cents. Revenue came in at $84.7 billion, 13.6% year-over-year growth, easily beat by $450 million. So both on the top and bottom line, we saw Alphabet pretty solid, delivered pretty good results there. But again, it's less about what you did for me, more about what you are going to do for me. So up 14% year over year, driven by cloud. That's a big focus for the company, the second largest segment for the company behind Google search there. So definitely overall at the top of the ticket, everything looks good there from Alphabet. Let's dive into the details though, just a little bit more to see how did some of these other segments do when it comes to Alphabet. So let's go right here. So as we can see, here's our revenue by segment that you can see. Google search, $48.5 billion. That was up nearly 14%. YouTube ads, that was the one single miss. So there was one blemish in this particular ticket here in terms of looking back at the results that didn't meet analyst expectations. It was the slightest miss there. But YouTube ad revenues came in at $8.66 billion. That was up 13%. But there at the bottom, you could see Google Cloud up 10.35%, a 28.8% increase. So that really started to slow probably 3 or so quarters ago. But we have since now, for 2-3 straight quarters, see the re-acceleration of Google Cloud, which is what we expected moving in towards this middle to back end overall in terms of Alphabet there. So a lot to like. As an investor, there's a lot to like in terms of what Alphabet's doing. I mean, when you look at just revenues are great to look at, but if it's not equating to anything, then it's all for nothing. We want to see companies that can increase revenue, but still operate the company in an efficient manner to where we're creating operating income, EBITDA, and most importantly, free cash flow. So when we look at operating income, we could see that Google Services was up 26.5%. Google Cloud up nearly 200%. Revenues up 28.8%. Operating income up 200%. Finding more ways to get even more efficient. Could this be some of those investments that the company's been making over the past few years? Diving more deeply into AI over the past 12 to 24 months? And now also increasing their CapEx again? Could this be, in fact, those things starting to pay off? If that's the case, I'm not worried about those investments moving forward. increasing your capital expenditures, if this is what you're going to be doing for me in terms of operating margin, in terms of operating income, this is a company I love. And this is why this company continues to be at the top of my portfolio in terms of individual stocks. Okay. Remember, I never have an individual stock at the top of my portfolio. Build that foundation first. But in terms of individual stocks, this is the highest on the list right now. And you guys know my love for Amazon. So Amazon is closely tracking that of Alphabet. So now let's go over to Tesla and check out what my good friend, strong sells on there, Elon Musk is doing. So if we look at the earnings report here for Elon, we can take a look at the summary. Here we go. Revenues came in at $24.9 billion. Nice little beat there overall. 24.7 is what analysts were expecting, so beat by 19 there. Adjusted EPS, well below expectations. Came in at 0.52. Analysts were expecting 0.62. Total deliveries, slight beat there overall. And then the important Model 3, Model Y deliveries beat there as well. But look at those gross margins. Let me get this going here for you so you guys can see this really fast. Gross margins fell 23 bips right there. Operating margin down 333 basis points there. So regardless of whether this company is increasing revenues, which the revenues aren't crazy, they're getting less and less efficient. We want to claim that they're not a automotive manufacturer, which they do have a technology piece to their business. Absolutely. But the margins are starting to look a lot more like a auto manufacturer. There's a lot of cyclical side of the business that is starting to creep in. Not starting, has been creeping in to Tesla. But I know that Elon wants to have this priced as just a technology company more than an auto manufacturer. So that's what you have to weigh as an investor when it comes to Tesla here. So again, plans for new vehicles. Obviously, let's try and garner our attention away from how poor our margins were, how less efficient we are as a business, and let's try and put focus on robo-taxis and new vehicles coming out and all of this other stuff that's probably not even close in terms of that. Let's try and put investor focus there. That's what Elon has been a master at. From that standpoint there. Total production plunged 14%, while total deliveries slipped 5% year over year from that standpoint. So two completely different reports when you look at Alphabet and when you look at Tesla. One fell double the other one, so that one made sense from that standpoint. But I can live with a very solid report that had a stock that was priced up towards perfection, and they made a few comments around capital expenditures. There's nothing fundamentally wrong with the business. In fact, the business is firing on all cylinders. They're just spending a little bit more than investors had thought they were. And the stock was priced to perfection. So it needs to come back down to reality. Tesla, on the other hand, completely different. That was a company that sold off for a reason. That was a stock that saw its company drastically over 300 basis points in margin depletion, just gone. Less efficient. Bringing revenues in, we're pouring out on expenses, whatever it may be. So two completely different reports from that standpoint there. So let's keep rolling ahead and get back here to the slides. All right. So is it in fact time to buy the dip? And we've been kind of talking about this throughout today's session here. Well, let's look at some of these valuations. Let's see where some of these major companies are, some of these big time technology, consumer or communication services companies. How about some of these tech giants in NVIDIA, Alphabet, Meta? How about some AMD? That's a stock that's actually high on my watch list right now. So when we look at Alphabet, we could see that their forward PE right now is at 20.1 times. Their 5-year average is 25.7. This is after today's sell-off. So in fact, now based on, although the company's performing quite well, when we'll have to see if some of those forward estimates change at all, which I don't expect them to change that much. Alphabet at 20 times earnings for a company with that much AI potential, which I believe they don't get enough credit for overall. They've completely fumbled the rollout of it, but that doesn't mean that it's not making a difference in terms of operating efficiencies. We've kind of seen that in the financials. You just saw that in the operating income there. Could a lot of that have to do with some of the AI implementations they've had? Potentially. How about Meta? That's another one that I like. And you could see that now we're going in and we've seen a big shakeup in the presidential election. Someone that's entering the race this late, they're going to have to pour billions of dollars into ad spending. That's going to help. And the other side, obviously, with Trump as well, he's already spending it, but he's had a plan that's been going in. The new candidate for the Democrat side has to come in and do some catch up because they were spending on a different candidate and now they have to spend on a completely different candidate. So let's push a bunch of new ads out there. That's going to help the likes of Alphabet, Meta, and don't forget about Amazon. Amazon's a sneaky advertising play. Now in one of the top 3 in terms of advertising overall. Growing at a fast pace, they don't get enough credit. So when you look at these companies, I love companies that have a lot of irons in the fire. When you look at Amazon, they have cloud with AWS, the largest. They obviously have their retail component. With e-commerce, they have their brick and mortar component. They have advertising, which they don't get a lot of credit for. They have Amazon Prime and the studio side of things over there. They're getting into more sports, live sports with the new NBA contract. A lot of different irons in the fire. And when one sector of the business isn't doing well, there's others that can pick it up. If you look at Alphabet, they have cloud, they have Google search, they have YouTube. Both of those happen to be the 2 largest in terms of search engines in the world. And they're owned by the same exact company. I love companies with a lot of irons in the fire. So now you got the chip manufacturers here with NVIDIA and AMD. NVIDIA right now at 32.7 times, historically at a 5-year average of 51.5. Now, again, for these higher growth companies, you really don't want to pay much attention to the 5-year average because those come down over time because these are companies that were trading at 100 times PEs, then at 75. And as they mature a little bit, those come down. But what you should take note of is NVIDIA has a PEG ratio around 1. AMD is not too far from that either, sitting right around a PEG ratio of 1. That is showing that the PE that you're getting compared to the growth that's expected, pretty good valuation. So some key components to look at when looking at overall valuation. And if you're interested in learning all of these different valuation metrics that I look at, I have a complete checklist, an investing process that I go through, and a valuation analyzing process that I go through every time I look at a particular stock to add to my portfolio. We have the investment coaching. But if you just want to stay up with the stock market and interact with me and many others, then you can sign up for my weekly newsletter. You can sign up for a free version and get our weekly recaps, or you can sign up for our Edge Plus. That's where you're going to see and get access to my entire portfolio. You're going to get a weekly report with a deep dive in an individual stock that we look at. You're also going to get reports on the top 10 stocks that I'm watching and many other things. We have a Discord community. Whether you are a free subscriber to the Stock Investors Edge or a paid subscriber, you can have access to the Discord channel. So I'll drop that in the comment section as well for you to check out. So if you're ever interested in those, feel free to reach out, folks. We have 2 spots open right now on our individual coaching. So if you really want to take your investing to the next level and say, hey, Mark, I really want to understand. I have some money available, or maybe I'm a new investor and I want to learn how to build a diversified portfolio that can build wealth for myself moving forward. Far too often, I come across it all the time. And, all of us have done it in the past where we want to try and do things on our own first, and then we get into a heap of a mess, and then we come looking for help. The right way to do it is to find and understand the education piece behind it, how to build a plan and a strategy first and foremost, then to jump into it from that standpoint there. So definitely some key things that you're going to want to look at overall. But let me drop both of those links into the comment section right now for you guys in case you want to sign up. So here is the first one. So this is going to be for the Stock Investors Edge. So if you check that out in the comment section there, if you want to sign up for the Stock Investors Edge, you can sign up for the free version, but you can also get a 7-day free trial, completely free for our paid membership, just to check it out as well. But if you're interested in the coaching, I will put that link here right now as well. So you can check that one out, and you could schedule this will take you to be able to schedule a call with me. I'll give you more information on the overall program openings, but we do this based on your time. And then we also have a group coaching that we just started our first cohort of the month yesterday, which you can still jump into because people are watching the recordings there. So if that's something that interests you, definitely let me know. So awesome. Well, let's keep going here and touch on housing. So we haven't touched on housing quite yet. We mentioned it at the beginning, but let's take a look here at what I was looking at on some of the most recent reports that we got as it pertains to housing. So as you could see here on the slide, sales of new single-family homes came in. This is the June report that just came out at a seasonally adjusted annual pace of 617,000. That was a 7-month low, nearly a 7.5% decrease from prior year. What were analysts and economists expecting? 640,000. What came in was not even close, folks, to what actually came about. So there's starting to be some cracks in housing. Now, if we look, that's for new single-family homes. Let's look at existing. If you've lived in your home for 10 plus years, 15, whatever it may be, and you want to sell your home, that's what's going to go and fall under existing home sales. Those, in fact, fell to the slowest pace we have seen since 2010. And many of us that have been investing for quite some time remember what 2007 through 2010 involved. Right now, we have mortgage rates hovering around 7% for the 30-year. And on top of that, how about home builder confidence falling to the lowest levels we have seen since December of 2023? So not a lot going right when it comes to the housing sector right now. So in terms of Fed, though, I mean, we talk about the Fed a lot here. I think right now still is I'm kind of going with the 2 rate cut procedure here. That's what I believe that we're going to get. It's kind of what I've stuck to since we've kind of been doing these shows and talked a lot about it. I know a lot of us on here have commented believing we were going to have 0. Now I think a lot more people believe we're going to have kind of between 1 and 2 Fed cuts. So we're starting to see a lot more things build up. We've obviously seen an economy start to slow. We have seen a labor market that has started to slow and showing some cracks with unemployment creeping up, average hourly earnings coming down from that standpoint. We have housing that high interest rates is definitely having a big impact on from that standpoint. The idea that rates are going to come down, that's going to bring pressures down on that 30-year mortgage rate from what was 8, now 7. Maybe it can get down closer to 6 or even below. But there's still a lot of people that are out there that are sitting on those sub 2, sub 3% mortgage rates that have no reason to move unless they are forced to move from that standpoint there. So a lot of great things overall to look at. I think there's, based on where we're at with this big sell-off, I think there is still some legs to this. When you look at the technical perspective, there's still a lot of downside to before this, a QQQ, an S&P 500 or anything like that, find some support levels. So if we jump over back here, give you guys a full screen so we could see the whole thing here, we could see these different levels for the triple Qs. Let me give you guys a full so you guys can see what I'm talking about here. So here is the triple Qs right now, and we could see that we've been trading in this different kind of upwards momentum here that has us still falling down another, call that 5, 6, 7, 8 points or so before we fall. Where's the 200-day level? The 100-day level has been pretty solid if you look back at the Qs over history. But the 100-day or the 200-day level is much further. That's down at around 440 on the triple Qs. Right now we're at about 463 there overall. Let's go take a look at the S&P 500. If we have a look at the S&P 500, we could see that we broke through the upward trend that we were in today. One reason we saw the big time fall down to 2.25% overall in the S&P, broke through that 50-day moving average. Where can we go? Well, if we look at it right here, where's the 100-day? That's going to be our next kind of line of defense overall. That's sitting right there. Where's the 200-day? That's much lower overall. So the 100-day is kind of at 530 right now. What's the furthest that we could potentially test and have a complete fallout? That's going to be closer to 510. So again, this is the SPY. So the equivalent, this tracks obviously the S&P 500. So just add another 0 and you can talk about what we were discussing earlier, S&P 500, 5,000. That would put technicals back lower around the 150, 200-day moving average. That would put fundamentals back in line closer to that 17.5 times PE multiple that it's traded at over the past decade from that standpoint. So as we approach that and get a little closer, you can kind of see, okay, would be a great spot to enter. And at the same time, right now, that also gives us concerns that says this downward pressure could have some legs to it. And we could finally, in fact, see a bit of a pullback. So that's kind of my take overall on where we're at in the markets right here. So that kind of concludes today's Power Hour. We're right at an hour right now, so right on the dot there. So I hope you guys enjoyed this session today. Again, show your appreciation by just clicking that like button down below. That shows me that you appreciate the content that we continue to put out, but it also shows Alphabet and the algorithm there so that we can continue to push and get to other audiences from that standpoint. And again, if you are interested in joining our weekly newsletter, again, we have a free version and a paid version. Check out the links that I dropped in the comment section there. And if you're really serious about investing and you really want to get a customized plan and really understand how to analyze a company, because there's nothing worse, especially when we're talking about dividend stocks, than investing in a company only to see a dividend get cut. Well, there's a number of things that you can go through within my checklist, a handout that you get that will look into ensure the safety of the dividend. But not only do we want to find companies that have safe dividends, we want to find companies that can continue to reinvest and at the same time grow their dividend. I don't want dividends that hold companies back. I want to invest in companies that continue to grow, but can also pay growing dividends at the same time there. So a lot of great stuff today, guys. Be careful out there in the markets. I think we could definitely see a return of volatility here. There's a lot of people that are way in the green, so there's some profit taking that's going to go take place. And if you look over historical trends, this is usually, in terms of seasonality, a little bit more of a difficult area when it comes to the stock market here. So this summer month of July can be seasonal in terms of seasonality, a rough time period, I should say. So just be mindful of that. Every single time you see a stock in the red, don't think it's a buy the dip perspective, because remember, if a stock's up 50% and it falls 3 or 4% in one particular day, it's still extremely elevated there. So that's why we always want to continue to look at valuation. I care less about 52-week highs and 52-week lows. I care more about, I don't mind buying companies at 52-week highs if the valuation makes sense. So, yeah, definitely. If you guys want to understand and learn exactly how I do that, definitely sign up for the coaching program. I will give you kind of some insight that, towards the end of summer here, those session prices are going to go up. We've had a lot of demand for them. Again, we only have 2 spots open right now in terms of the individual coaching program. So if it's something that you obviously heard me talk about and you've been kind of waiting, definitely get in before we increase those prices here. I really appreciate you guys sticking around for today's Dividend Power Hour. And with that being said, I hope you guys have a great rest of the week, and we'll see you next week. Take care.